I'm going to get on now. I see Jimmy.
Hello, Barry.
Hi, Barry, you can go ahead and begin.
I don't see anything on the screen. Good morning. My name's Barry Summerstein. I'm a partner in the Fort Lauderdale office of Greenspoon Martyr. And today we're going to have a very interesting and diverse group of panelists talking about development in the age of COVID and how developers can keep things moving. I'm hoping that while I moderate this panel, I do a better job than Mr. Wallace did last night. But I think you're going to find the discussion interactive and interesting. And if you have any questions, I would ask that you please raise them and we'll try and address your questions as we go through. Let me first introduce the different panelists. We have Rocco Ferreira, who's the Chief Investment Officer and Director of Stiles Corporation, who's responsible for strategic planning, direction, and oversight of properties owned and controlled by the Stiles Company and their numerous partnerships. Under the leadership of Rocco, working with a very highly trained group of professionals at Stiles, they've been involved at the acquisition, JV structuring, finance, asset management, property management, and disposition of real estate. I think Rocco will have great insight, more than the others maybe, on office and retail properties. The next panelist is from out west. His name is Gary Gold. Gary is the Executive Vice President of Hilton and Highland, who's a premier real estate agent in the luxury market of real estate. He's been involved in sales of small little properties like the Playboy Mansion, which set a record sale at $100 million in Los Angeles, only to be dwarfed by his sale of the Cartwell estate for $150 million. Gary's also a trendsetter in the area of marketing, real estate, and involved in technology, marketing, and publicity. And I think those of you who have been active during this crisis have been involved in the new normal on how to market real estate. So I think Gary will have great insight in that area. Our next panelist is Greg Logan. Greg will be making our first presentation today, running through some slides that he's put together for you. Greg is the Managing Director of Community Resorts at RCLCO. Over the last 30 years, Greg has worked with many developers, lenders, landowners, investors, and helping them make prudent investment decisions in their real estate investments. Greg is published in the New York Times, the Wall Street Journal, the Washington Post, and he's been a speaker at the Urban Land Institute. And Greg will have great insight to help lead this discussion off in a couple of minutes. Our next panelist is Jimmy Tate. Jimmy's president of Tate Capital. Jimmy and his brother follow their father in a long-time family real estate business that is owned, developed, operated, and managed properties all across the country, as well as been involved in advising public companies and foreign governments as far as what the trends are in real estate. Jimmy has developed, owned, and managed commercial, industrial, single family, and multifamily properties through his various entities. They've owned, operated, and managed billions of dollars in real estate and has been involved in workouts, as well as specializing in the acquisition and servicing of distressed debt and real estate. And finally, but not least, is Jake Wurzak. Jake is the president of Wurzak Hotels. group. Jake has served his company as in-house counsel and co-general counsel. He has been involved in his family hotel business from a very young age and is passionate about hotels and developing hospitality concept in order to better enhance the guest experience. He's focused on analysis and execution of new acquisitions and dispositions, deal structuring, new business development, and pursuit of third-party management agreements. And I think you'll see that Greg has great insight as to where the hospitality business is today, where it's going, and what can be done to help that industry. So with that, I'm going to ask Greg if he can take us through some slides to get us kicked off on our discussion this morning.
Great, thank you, Gary. We can just go to the next slide. So we did a survey recently with about 3,000 real estate industry professionals, probably maybe 50% C-suite, just asking their predicted degree of economic impact by land use, just to kind of run across those that are being impacted the hardest. And no surprise there, you see your retail and regional mall and hotel hospitality kind of at the top of the chart with the greatest predicted impact, and that is in fact what we've seen. Although as you'll see on a couple of slides in a minute, we are seeing some improvements there. And then at the other end of the spectrum, with the least amount of impact on industrial, where people sort of rethinking how much material we want to have on hand for manufacturing, how much goods we want to have near stores or near warehouses that are doing delivery, more opportunity to create more last mile industrial space and so forth, sort of at the other end of the spectrum. And then other property types in between, residential, for rent residential has done well. For sale residential, we'll see in a minute, actually is come roaring back pretty quickly. So if you go to the next slide. One of the questions that we're asking in our sentiment survey of real estate professionals is, so just how easy is it to find capital for projects, for new development, for existing development, for stabilized income producing, and not too surprising the feedback that we're getting and seeing, and be interesting to hear as we get into the discussion part of the program this morning what your experience has been. But by and large, securing equity to recapitalize stabilized assets, not that difficult. Securing capital for refinancing. For new developments, availability is a little bit tighter. A few people saying not available. Most people saying more limited availability for planned new development, but for deals that are already going concerns, pretty strong. And then continued funding available for projects that are already under construction. As far as doing development during COVID. You'll flip to the next slide. One of the things we always hear every time there's a recession is that personal consumption expenditures are 70% of gross domestic product. So whatever consumers are thinking has a big impact. If consumers stop spending, then that has a big impact on what's going to go on in the rest of the real estate economy. Other people will argue, well, yeah, but business spending is also pretty key. When business spending slows down, then you see the GDP really take a hit. And then the sort of the third point of view is yes, but without consumer confidence, then businesses are typically not expanding. So the good news is, looking at the Conference Board's September numbers, up across the board in some cases, more up than others. But looking at consumer confidence overall, about 15 points up from August. Employment trends up, a couple percent. The help wanted on the job side and leading economic indicators, and CEO confidence not up as much since August, but still a good upward trend. So that's what we want to see going forward. On the next slide, one of the things we've been tracking, and this is from NAREIT, just looking at what percent of rent is being collected across different real estate categories as an indication of their health. And you can see industrial really leading the pack there, and then retail, both freestanding and shopping centers, even being impacted more heavily. Office, considering where we've been, office has done okay. Even those of us who are not back in our offices yet, we're still paying for those leases. We may be thinking about, whether we're going to renew them. Apartments, somewhere in the middle. But overall, not a terrible trend, particularly when we compare to where we were in the last recession. Next slide. This just, if you go back to that slide just for a second. Just again, looking at where we are. The main thing I want to show here is on the shopping centers on the far right in the left box. Shopping centers, it's been a hit, but we're not at that 50% level we were back in April. So coming back, and deferrals are way down from where they were. So that's a really good sign. Looking on the next slide, on the housing market, we've seen that come roaring back. At first, we thought we were making up for the losses that we had in March and April, but really we've quite exceeded that. Consumers are people who've been sitting on the fence thinking about getting a bigger house. There, people who've been stuck at home are thinking, I need more space because I need 2 home offices, not just one now, since wife and I are both working from home. The kids are homeschooling. We got our college kids home who are doing their online classes. We need more space, and we want to get out of this denser area and get somewhere in the suburbs. We're not worried about our commute anymore, so I can move a little farther out and get a little better value, and that's what we're seeing all day long. And certainly it's been really strong for master plan communities and other residential real estate developments. On the next slide, you see that's pretty regional. The south part of the country really having the greatest impact in terms of new home sales, but pretty strong in the west. The northeast and Midwest are smaller markets. They're up, but not nearly as much as the south or the west. And on the next slide, existing home inventories are way low. A lot of people not wanting anybody traipsing through their house in the COVID era, so that people aren't putting their home on the market. That's been really good for the new home market. And then on the next slide, looking at where we think the market is going for single family, 2021 for new single family residential looking very strong. We're already hitting that third quarter pace. We probably have exceeded that third quarter pace. This is Fannie Mae's forecast, most recent forecast as of earlier this month in September. I'll go ahead and advance the slide. The one thing that we're thinking about is that, some economists, and this is from the conference board, but you can see this from other economists as well, are saying, with the fact that we still have 8% unemployment and we've kind of wound through some of the fiscal stimulus, Congress and the White House have not authorized additional stimulus. So, that could slow things in the fourth quarter, and that may drag it out a little bit farther, and that could have some impact on those numbers. But by and large, what we're seeing are, pretty strong fundamentals. And so with that, I'll wrap it up. Thank you, Barry. Back to you.
Okay. Jumping off from those slides, I'd like to ask each of the panelists to give their input as to what they see, where the economy is today, and where they see it going and its impact on the different real estate classes, what the impact is with employment, supply, government regulation, and quite frankly, the election. And so if we could first begin with Rocco, if you could talk a little bit about what you're seeing in and what you expect to see in the retail and office market, and people changing the way they are approaching coming into the office and doing their retail shopping.
Sure. Thanks, everybody. Thanks, Barry. I think, in my personal opinion, and as you mentioned, we're more focused on office retail, and we are specifically more geographic focused to the Southeast. So you have to kind of temper any opinions with that in mind. But I think, look, real estate development in general is a slow, high intense capital, and we don't adjust to change quickly. It takes years to envision projects, get them executed, get them capitalized, and get them stabilized. So when you have this immediate punch to the face, which we got with COVID, it's hard to react. It's hard to know exactly. I think my general feeling is things are unsettled still. I mean, we we had this global shutdown. We stopped the largest economic engine in history. The government stepped in, reasonably they had to, with stimulus, with PPE, with outsized unemployment, prohibiting evictions, all the normal things that in a correction would happen have been delayed and postponed. So I just feel like when they turn the economy, when the government decides it's going to let the private sector kind of do the stuff it needs to do to settle this, that hasn't happened yet. So candidly, office leases are generally long. So tenants are all trying to figure out what they want to do. We've gone through a almost decade-long densification of office across the country, and now it's probably going to start going a different way. But I don't think that's settled out yet. I just don't feel like there's a consensus on office space and what it needs to be. We're finishing a building right now, for example, across the street, and we've spent hundreds of thousands of dollars upgrading to ionized air conditioning and eliminating touch points and all the things that every COVID expert says we've got to do. But it's been very quiet. The momentum in office leasing, and I can tell you in other markets we're active in, is similar. So I just think it's going to take some time. It's going to take some time for corporate users to figure out what they want, how they want it, how much remote action or remote activity they're going to have. I'm not seeing clear direction there yet. I think of the things that we do, it's the biggest question mark I have. Retail has taken a brunt of this. We've made many concessions. We've lost some anchor tenants, but there's hope there. I think the grocery business has been strong. Anything related, if you looked at Greg's chart, anything related to homes, home built or home furnishings, home supply, they're on fire. So will they expand? How much they want? How many vacant boxes are going to have to be, backfilled by those kind of uses before developers can start doing new things? I think again, that's just not quite settled out yet. But there are signs of hope there on the retail side. I feel generally.
Jake, what are you seeing in the hotel setting?
Hotel business is terrible right now. There's not anything to be optimistic about. In June, we started to see a little uptick with the rise in summer travel, maybe people rationalizing their comfort level with COVID, but that has certainly leveled out. We have hotels throughout the country, and with the exception of 2 hotels that have essentially leases with universities for dorm rooms, all of our hotels are below 30% occupancy for September and October. And in terms of where we are in the real estate cycle, in the hotel world, we've been asking that question for the past 3 years. So it's exciting to say that we're actually at the early stage of a new cycle. And I think the old cycle ended probably at the end of 2019, somewhere around there. And we were kind of just sitting around figuring out what was going on. And now we're at the early stage of a new cycle. And that provides excitement because frankly, that's where the best deals are made, the most money is made at the early stage of any new real estate cycle. So in our existing portfolio, we're making sure our balance sheets are flush and ready to carry on what we think is probably a 2 to 4 year prolonged downturn with the deepest recovery or the deepest decline happening right now, and then a pretty steep recovery. But by the time you get back to 2019 levels, it's probably not till 3 or 4 years, depending on the market that the hotel is located in. And from a supply standpoint, it's a positive because no one's developing a hotel right now. There's no financing. There's barely financing to buy a hotel right now. So if you had previously been under development of a new hotel pre-coronavirus, I think that's actually a great thing because now you're going to be opening up into an environment where there's a recovery. To start a development right now, I think is going to be a challenge for a number of reasons. And that's why the supply picture is probably going to decline as we're going into years 2 and 4 of this recovery.
Thank you, Gary. If you could, housing seems to be the surprising bright spot in this COVID world. What do you see the positive trends in housing, both in production housing and in your bailiwick of high-end housing? And what do you see as to the negative aspects going into 2020?
Well, the positive is there's just no inventory. And more than anything else, more than the economy, jobs, anything, it's just a question of supply. If there's not enough supply, is not enough supply to meet the demand, prices will go up and inventory will continue to shrink. So I'm very positive about that. I'm also very positive that houses have just become intrinsically more important to people. People are working out of their house. They're spending a lot of time in their house, way more than they used to. And people also have that concern that something like this could happen again or continue to happen. So people who can afford to are, to anyone's ability, if they can afford to improve their home, they're going to do it. The only negative I see with such low inventory and housing doing so well, that in the long term creates a lot of people who do, remodels and flipping and development, and low inventory creates the desire to build more. And eventually it happens every time, there'll be too much inventory because people will developers, whether big or small, are going to overcompensate for the need. And then at some point you have too much inventory, and then prices start going down and the cycle continues. And what happens with that, when you have too much inventory, everyone gets killed. All the developers get, hammered really bad, and then there'll be no inventory. It just goes around and around and around. We're 11 or 12 years of prices going up. We're overdue, but it's not an exact cycle. It doesn't happen exactly every 10 years. It just doesn't work that way. Right now, it seems like it's good. I don't see any signs that it's going down other than we're overdue. So that's the only thing, is just, I know this does happen. I've been through 3 or 4 of them. They don't run consistently with the economy. I've been in bad economies where prices were going up. It seemed almost crazy. And I've been in good economies where real estate wasn't doing that well. So they have their own set of economics that they're driven by. I mean, there's some relation eventually, but it's not in real time.
Gary, thank you. Jimmy, I'd like for you to lead off and then maybe have Greg discuss where you see the general economy as a result of COVID and its impact on the different classes of real estate. I know you're involved in owning and managing and operating, both industrial, office, retail, hotel, apartment. So I know you have an on-hands insight as to this. So if you could give us some of your thinking on that.
Thanks, Barry. And thank you, Greg and Jake and, Gary and everyone else who spoke previously. I just have a couple questions first, and then I'll get into where I see the economy going, because I was a little confused, and I appreciate first Greg's research and the results that he gave us. But, one of the things that Greg mentioned was that there's an 8.5% unemployment. And I think unemployment is a key factor here to really get our arms around where the economy is at and where it's heading. I hear the same numbers, on the news all the time, 8.5%. But I'm curious what Greg's research shows, because it wasn't that long ago, April and May, where we saw over 44 million people lost their jobs. And we only have 157 million people in our workforce. So to me, that's 26% unemployment. And then we heard last night in the debate how the economy's turned and we've, recreated 7 to 8 million new jobs. So even if you take 7 to 8 million job creation to put those people back into work, I don't see where we're at 8.5%. So I'd like Greg to maybe explain to me, what am I missing? Because I'm not seeing the 8.5% unemployment. Are these people just removed from the workforce? Is it because they're collecting unemployment insurance? How does everyone keep coming up with the 8.5% unemployment? And the reason that's very important is because I think unemployment figures are the single most important common denominator, or what's going to dictate where we go as an economy? So I'd first like Greg to answer that, if you don't mind. Can't hear you, Greg.
Greg,
Yeah, I
you need
think
to.
I was, yeah, okay, I'm unmuted now. Well, to your question and Barry's question as well, you know, I'm not making up these statistics, but you know, the official U.S. Unemployment rate is around that 8.4% range. It is. We have seen a lot of jobs coming back. We lost a lot of jobs in the service sector and retail and hospitality in particular. With bars and restaurants reopening, we've gotten back some of those jobs. It's been somewhat of a tale of two economies. And so one of the things we're asking ourselves is, how can we have this booming housing market with all these people coming out and buying houses and have this huge unemployment? And you know, part of the reason is that the unemployment really hit certain sectors of the economy and not others, and that a lower wage service sector was impacted to the greatest degree. Many of those jobs have come back. We've seen you know, significant reemployment. There's also, to your point about you know, people who have sort of maybe given up. They're not back in the workforce. There's definitely some jobs that are not coming back, and that's a long-term trend that we were already facing, where you know, more and more jobs are being automated. You know, how many times do you know go ahead and try and call somebody at Amazon to complain about a delivery and let me know how many robots you talk to. So that was already a trend that we were looking at. And a lot of jobs are not coming back. The companies have looked at, you know, how well they did with the layoffs. And so that's going to be an issue. And we're going to have this issue of sort of two economies in the US, those that are in jobs that are less impacted through this crisis and less vulnerable to long-term trends where they're going away and being automated. I think that you know, the other point that you made about made by the last couple of speakers, James made this point as well, that we kind of worked through the stimulus, and now we're getting into you know, the kind of the economy without stimulus. The good news is a lot of these jobs have come back. The good news is there's a lot of us, like all of us on this panel, I think, who have been able to continue on with our jobs and to work from home. So lucky us. That's not everybody, and so there's sort of, you know, two tiers to the economy and what's happening. But the official number right now is 8.4, and you know, back in 2010, as we were coming out of the Great Recession, unemployment was at about 10%. You know, we had much greater unemployment going back to April to March and April this year, but we have seen that come down quite a bit, recognizing that some of that is you know, people who are maybe not coming back into the workforce, and that may underrepresent some of that.
Well,
I don't know if you wanted me to ask the question about you know, where the general economy is going, but
no, I appreciate that. In my opinion, I think unemployment is one of the key factors that we need to look at, and I think people are just glossing over it because, yes, the government is putting out the 8.4% unemployment number, but I know, for example, in my hotel, we had 155 FTE at the BHMR Resort and Hotel. We were able to keep everyone employed when we had the government, you know, funding from the CARE Act. But then, once that ended, we had to go back to an FTE, a full-time employee of about 41 people. So the balance of those people, some were furloughed and some were just let go. And until we can get back to a break even, we don't have the ability to hire those people back. So, you know, are they on unemployment insurance? Are they considered unemployed? Are they outside the workforce now? And you talk about two economies. I agree with you, but therein lies another problem, because you're going to see a real division in the markets and a division of wealth, even far greater than what we experienced before. And something that will amplify that is the pivot to digital, because everyone confirms that, you know, technology is one of the curses to the middle class, you know, because of robotics and all the other, you know, transformational benefits that we're seeing through AI and other digital sources. It's wiping out the need for people to come into work. You can do a lot more with a lot less. And that's good on some fronts, but it's bad on others. And I think that if we have huge unemployment, you know, everybody on this call seems to be looking at the light at the end of the tunnel. To me, I see a train. I don't see light that's good. I see a train coming at us, because I think when you have such disparity in the markets, you're going to have more confusion. You're going to have more financial crisis and more fear. And that, coupled with the fact of the pandemic, I see that, you know, there's just a lack of political leadership on both sides of the equation. This is not a political discussion, but I don't see a solution on either side. So I see some turmoil, and I see some rocky roads. And you know, as owner and operator of many different types of real estate, like for my retail, yes, your numbers are correct. I'm seeing about 75% on average on my retail centers around the country on collections. But I could tell you every tenant other than the national tenants that I'm trying to start working on their lease renewals for next year, either A, don't want to stay, they can't afford it, or B, they want major considerations, starting with rent reduction. They want me to wipe out the deferrals that I gave them over the past month. So what's that going to do? That's going to decrease the value of all my real estate centers, because all my real estate commercial centers, because my NOI is going to go down, you know, and we're working on low cap rates right now. So, you know, you have a low cap rate, you have a high NOI, you have a really high value. Well, I don't know how long cap rates are going to stay at these historically low levels, and NOIs are going to start to drop down. And for those that are listening, that's net operating income. So you're going to have a devaluation of a lot of properties. Now, is that going to throw a lot of loans into default through a breach of a covenant because you're no longer hitting your debt service coverage ratio, or you're no longer hitting your loan to value ratio? There's just so many uncertainties in the marketplace right now that have me very concerned. And, you know, I agree with Gary. We have low inventory and low supply, which typically means higher prices, and that's good for the economy. But, you know, who's going to eventually be buying these homes? You know, you have the people with the money, and then you have all these people that don't have the money. One of the reasons our economy was so strong over the last 3 years was because if you pay attention to the food stamps and the poverty level, I think food stamp dependency when Trump took over was at 48 million people. It's now down to 40 million people. It's a number that people don't pay attention to, a drop of over 20%. That means more people have moved from that poverty level to a lower middle class. Are those people now going to move back to poverty level, meaning they need more dependency on the government? Are we heading more towards a socialistic type government to help these people? I'm very concerned as a real estate owner and developer about where our market's heading. And I see a lot of turmoil in the streets and confusion. And look, that could be an opportunity for some, but, you know, looking from 10,000 feet down, I see a lot of people scrambling right now looking for answers, and I don't see a clear answer out there, which usually means there's going to be some market turmoil a little bit longer. I don't see the rosy picture that, you know, some of you may see. I'm not saying you're wrong. I'm just saying I personally don't see it, just from a basic economic overview.
Let me ask this question.
Clearly, there's winners and losers. Maybe we should talk about that. You know, what are the categories that are winning, and which are the ones that are losing? You know, I think if we look at on the retail side, retail was already in trouble before COVID hit, because, you know, online shopping had was shifting retail space from store space to warehouse space, and now online shopping has really gotten a terrific shot in the arm, and so we are seeing stores needing to prove their relevance somewhat more. You know, the antidote had been, just, power centers where all you were doing was going there for everyday low prices. You can get that online and get it delivered. And so we're shifting towards experiential retail and places that you wanted to go because it was fun. Well, now that you're not, gathering together in groups of people, that's being impacted as well. That will end. And I think we'll continue to see the shift towards more experiential retail that you want to go to. And we'll see more of a combination of retailers having a stronger both sticks and bricks as well as online presence. But we have too much retail space out there already. We already have much more retail per capita than most other countries. So retail was already struggling and will continue to go through a significant evolution. On the residential side, the low inventories that Gary was talking about, those are going to impact prices. We already had an affordability crisis in this country. And so we were already, 15% of the housing we were building, only 15% of Americans can afford a new house anyway. And now the resale market is very tight. That creates new opportunities. We're seeing an explosion in the build for rent space. Everybody wants to get into build for rent. And what we're building is still, way below where the demand is for build for rent. So we're not building the first time buyer housing that we used to. That's creating a big opportunity for both builders and traditional multifamily people. Developers have been building for the 20 somethings to build now for that segment of people who don't want to tie up capital or don't have the down payment. And so that's a huge growth area with lots of opportunity.
Except if you look at the multifamily development opportunities, I'm still seeing deals, because people haven't had that touch of realization yet. If you want to buy land, if you underwrite a new opportunity, you're underwriting it, below 6%. So where's that spread?
Yeah, it's getting harder to underwrite multifamily because we got spoiled. We had big, 4% annual increases in rents. And so the annual increases in rents were going up faster than incomes. And we're building for the 20 and 30 somethings. And they're getting ready. They're moving into that age range where they want a house. And so there's still opportunity for multifamily, don't get me wrong. But I think right now, I think where the real excitement is in build for rent product. You have, Tricon out of Canada going out and trying to acquire, 10 to 12,000 new units. You've got, BB Living, American Homes for Rent, Coastal Ridge, Next Metro, all these folks out there, who are really having an exciting time right now. Office is kind of mixed. So I think we've all kind of realized that, not all of us need to come into the office, or we don't need to come in every day. And that's going to have an impact on just how much office space we need going forward. On the other hand, we need to spread out more. This idea that we were going to, create these gang spaces where everybody could come in and collaborate. The truth was, part of that was we're also, it was a way for tenants to save money on how much space they needed. We got to space people out again. So, somewhere between maybe 20% of people not needing to come into the office anymore, at least, and needing to space people out, it probably evens out in the long run.
Really think that people are going to continue working from home. I just read a Wall Street Journal article that said that productivity on average is down 25% across U.S. countries, because productivity with people working at home versus being in an office setting and being able to get the energy from the person next to them and communicating and talking and being more efficient, coming up with ideas and concepts, that's lost. And now they're saying this working from home isn't working, and companies are losing a part of their productivity. So
Greg, let me just
80% of the market will still use office space, but that's 20% is a significant hit.
Greg, let me ask Rocco and some of the other panelists. I don't know about you, but Jimmy mentioned a few minutes ago the digital age and how it's transforming everything. I got to tell you, if I do one more Zoom call, it'll be one more than I really want to do. I'm actually looking forward to being able to get back into the office. And so I'd like to ask Rocco, from a office point of view, are you seeing developers and users changing their philosophy as to how they're, because they're not going to stop office space. I think the socialization and the interaction, as Jimmy's talking about, to maintain productivity is too important. But are you seeing a change in planning from both the user side and the developer side as to how they're structuring their office products?
It's starting. I haven't seen a ton of it. I mean, as an anecdotal piece of evidence, we are the building I mentioned we're finishing now. We had a third of it pre-leased. Those are law firms and public company and financial service companies. None of them have changed their plans. They've all stuck to their original plans. So we're moving as well as a company, and we're thinking about it. Do we really need as much space? How much hoteling and shared space do we need? But I find that I agree with the other comments. I mean, we are not as good apart as a company personally. I mean, we don't have those moments together where we come up with ideas, come up with plans and strategies. We have no way to mentor younger people that we hire when everybody's remote, which is a big part of our business, bringing up that next generation. So it just doesn't, you can run a business, but you can't drive a business. You can't really strategically move a business. So, I think there's, the co-working thing is probably on hold for now. That, as Greg mentioned, that just jamming a bunch of people into a space, that's probably gonna be a while before that recovers. And so I just think, honestly, we are the front end of a redesign of office and a rethinking of use of office. I think geography and migration is going to play a big part of that. We haven't really talked about that much, but I think some markets are going to win more than others when it comes to that as well. I hate to be ambiguous, but really it's only just starting now, really, as far as I can tell on the future of how space is going to be designed.
I'd like to ask each of you, maybe starting with Jake, as to what you're seeing in dealing with capital raise, both from a equity side and dealing with debt in connection with the various real estate products that you're all involved with.
Absolutely. So during this downturn, we actually raised a new fund targeting distress in the hospitality industry, and we've made one investment, and we have 5 more under agreement that will close probably in the next month. The big players out there, the big real estate private equity firms, are largely sitting on the sidelines right now. They are not a part of the deals that are getting done right now. They're either too small or they're waiting and watching to see. So I think that's an opportunity for the entrepreneurs. I think that's an opportunity for the people that have capital, that see an opportunity, that want to do things. From the lending standpoint, we're actually a part of a transaction that closed post-COVID. And when you could ordinarily obtain 60% leverage on a hotel, that project was only able to get 30% leverage even after a significant discount on the acquisition. And then they backfilled it with 30% mezz on top of that. So the financing markets are very challenging from a debt standpoint in the hospitality space. However, for large, generational type assets, you are starting to see some progress with new debt issuance around those type of stories, which I think is interesting. It's encouraging. The rates are a little bit higher than they were. And then from the equity side, it's totally mixed, just like the economy. You have people that believe that there's a recovery coming soon, and this is the best time to make returns. And there's some people that are still cautious and waiting and seeing. We've been partnering with a group that just raised $1 billion fund from public pensions and universities. And so, there is desire to go out and make investments right now if you have a proven strategy, and if you've done it maybe in 2009 and you can show a track record from even very large institutional capital sources.
Rocco, what are you seeing in the financing world?
Oh, I think there's no shortage of capital out there, personally. And another anecdote, we went out earlier this month to raise some capital for an apartment project here in South Florida. I had no idea what to expect. I really wasn't sure what kind of reaction we were going to get. $90 million project, trying to raise $35 million of equity. We went to a small group, and without exception, they all responded that they wanted to do the project. And honestly, and maybe this is part of Jimmy's point, the return expectation candidly is no different than what I would have expected if this were September 2019, and the structure of the proposals. So, you know, that's South Florida. We have a track record of developing and relationships doing it. I can certainly, I mean, I agree, you know, maybe it's different in other parts of other markets and other places. So all that has to be factored in. But I think, you know, for the right opportunity, there appears, at least right now, encouragingly to be capital for development.
Based on what's happened with this virus, what are each of you seeing as far as whether there's a geographical shift in where real estate is heading and where the population is moving to? Gary, what is your feeling on that?
It's funny, for the last, it seems like 15 or 20 years, people have been moving from rural and suburban areas into the city, and I couldn't sell a house next to a retail store 20 years ago if my life depended on it. That was a undervalued property. Now that became, of recent, the more desirable thing, to be able to walk to everything. And then it seemed like 3 months ago, lots of people turned around and started heading to the suburbs. And there's a lot of suburban areas. I know on the East Coast, a lot of people are moving out of New York and want to go to places like Greenwich. So I know these more far out areas are becoming more desirable. The one thing I did want to mention, because there are some things that are happening that are bad, but the pendulum's going to swing, and people can't wait, I bet you, to go to a hotel and spend $15 for a glass of orange juice and spend 15 minutes trying to find a parking spot in a mall and go to the office and commute for an hour and get stuck in traffic. I think people are going to really miss that. I think they do, and people are going crazy at home, even though there's some benefits, and it's going to swing the other way, and all that's going to come roaring back. The economy is the economy, and there'll be bumps in the road and winners and losers, but this is going to turn around very quick when we have the ability for it to happen, and it'll be the opposite effect.
Well, I hope you're right, Gary.
It's just nature. I mean, it'll definitely happen. There's no question about it.
Well, I hate to ask.
I can tell you in the hotel business, we're starting to see through the summer months, there was a lot of leisure travel. So Gary, to your point, I think as people start to venture out with their families, they will soon get more comfortable and then start traveling for business. And that's really the main driver behind, your group business for hotels, your convention business. But until people do that socially with their friends and family, it's going to be challenging probably to get them to that mindset to do that for business. There's also a couple comments made earlier on office, and in this world of two economies, these large tech firms have such an infrastructure to work from home. They have so many people, their depth is so expansive, and their technology is so strong that when Google comes out and makes a statement like everyone's going to work from home from the next 2 years, how can entrepreneurs compete with that? And what kind of standard does that place on everyone else who does want to return to the office, who does want to get back? Because during this whole period, if you ask an entrepreneur, hey, are you willing to give up your business that you created for 20 years, to COVID, or are you going to fight it out and try and make it work? They're all going to tell you they're going to try and fight it out and make it work. But when you have these massive tech behemoths setting a standard like that, I think from an office perspective, even from a hotel perspective, that's really challenging for us to overcome.
I know in the last economic downturn and in this area of COVID, there are obviously, as you've heard, winners and losers. And over the time, that's going to change and evolve. But there's going to be a fair share of distressed real estate out there. In the last downturn, I know that just speaking personally, I think I was able to make more money, not just from practicing law, but from investing, buying distressed debt and distressed real estate. Where do you see the acquisition of distressed acquisitions of debt and real estate It seems like it may be a little early, but I'd like each of your views on that. We're running with about 5 or 6 minutes left, so I think I'd like to hear your insight as to not only that approach from both an investor and as an owner on the other side of the ledger, trying to maintain your property, as to how you work out with your lender and your investors in order not to turn back the property. So, Jimmy, how do you look at that?
As you know, our company, Tate Capital, has always been at the forefront of a kind of contrarian view at these switching at impact, points, inflection points, if you will. And, we're always, if you remember the early days, 2008, 2009, when we first did a Ameribid, and then we came out with the whole, the real estate solution concepts to buy the distressed debt. One of the things we did was we pulled ourselves back from the chaos. And when everybody in the entire herd started running to the right, we stopped and looked back to the left, and we were able to pick off a lot of opportunities. And we were able to use our relationships and capitalize on those, buying distressed debt. But there's a big difference back then, because if you remember what we did, we bought income producing assets, or we bought the debt for income producing assets. And during our due diligence period, we were able to work out a deed in lieu situation with the guarantors on the notes. And it was an entirely different environment. And we were quite successful. And we and our partners all did quite well, as you're aware. There's a big difference. Since 2008, most people, and I guarantee everyone in this webinar will tell you, nobody signs personally anymore. If you remember, the key to our success was we were able to work out a deal with all the people that are on these $100 million notes and $50 million notes or $200 million notes. We gave them an opportunity to walk by handing us the keys. People aren't on the hook anymore for debt. You are during construction and development, but so you'll get a 3-year mini perm. But once the development's done and the risk is off the table, and that's usually just for performance, they're off the hook. So I think there was a shift in the way debt was structured. Debt became very easy, and people are getting 60-70% debt and no personal guarantees. So I think it's going to be a lot harder to get these assets from the buyers and work out deeds in lieu of buying it from the banks. I think the banks are going to have a realization and either want to deal with the buyers, or they're going to be ending up taking back these properties, which I don't think the banks want to do. And I think history will show you, whether it's through the Resolution Trust Corporation time period, the late 1980s, or this last recession, if the banks would have worked with the original owners of the property, everybody would have been better off. So I don't see, other than CMBS opportunities, which are going to go to larger institutions, I don't see real opportunities. There may be one-offs here or there, but not to the magnitude that we saw before. There was hundreds of billions of dollars of distressed debt opportunities last time. I personally don't see it. And even if I saw something today, personally, I would stay away. I think there's too much untold story in the marketplace right now for at least another 6+ months.
It's also going to, in residential, they'll also, this happens, as I said, it's cyclical, but it'll be less than, back in 2008, because just people in general have a lot more equity in their property. They can't get these crazy loans. The average person in the United States, over 50% of the people have over 50% equity in their house. So it's just, the opportunity isn't there to be as bad as before, but it does happen. And there's also a lot more sophisticated people in residential. So I think there'll be a demand for it.
Rocco, how do you and Jake look at that aspect of distressed debt? You're dealing with it, and advising your investors, as well as how you're dealing with it on the properties you own.
Well, I think there should be opportunities. And I assume Jimmy was referring to the early 90s and not so much the last financial crisis, because candidly, there weren't that many distressed opportunities coming out of that. There were a few, but we've said it already. This event has only accelerated trends that were going to happen anyway. So the bad retail center that has been hanging on for dear life is now going to be available. So it will trigger some things. It will trigger some opportunities. There will be office buildings that are just functionally not going to be able to be used as office buildings anymore, and someone should come up with a creative way to repurpose them. So hasn't happened yet. I expect it will. I agree, Gary too, there's a lot of capital ready to go if that happens. So it should be a fascinating, 12 months from here, I think.
Jake, what's been your experience in this area? I know that you've created some new funds.
Yeah, so we've been focusing on preferred equity investing. We've looked at some notes, but to Jimmy's point, the ones that we've seen so far were financed with kind of inflated LTVs. So, the bank maybe thought they were doing it at 70% loan to value, but it was inflated. So it's probably like 90%. There's really not a lot there unless the lender's willing to take a significant write down. So I think there's still a disconnect. There's a couple of those deals floating around, but where we've had success is preferred equity. Because the beauty about preferred equity is I can think the value is X and the seller or the common equity can think it's Y, and we can still get a deal done as long as I'm comfortable with my basis. And if he believes it's Y and I believe it's X and I'm money good at X right now, regardless of what happens in 4 years, I'll be fine. And that's where we're having a lot of success because you need cash right now to weather through this 2 to 3 year period. And the fun part is really figuring out where you can go in the capital stack. The other thing that's great about preferred equity is the debt's already there. You don't have to do anything. The debt is already there. So you already have the asset. You just go right in to the existing partnership and your basis is capped unless you're required to put in more equity. And then there's things that you can do to further protect yourself in those instances. So that's what we're seeing getting done right now. But, the PPP is running out. The forbearance is running out. So they're just starting to really build momentum, and they'll continue to build as those government stimulus programs fade out.
Well, I think this has been an excellent discussion, and I believe we're running out of time. So I want to thank each of you for your insight and your help today, and advise those that are listening to be prepared to listen to the next webinar on education in a pandemic. Thank you all very much for participating, and I appreciate your discussion.
Thanks, Barry.
Thanks, guys.
Goodbye. Take care. Thanks.
Bye, guys.